Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
There are way too many buttons to turn that thing off and on.
That makes it look too easy.
Yeah, that guy's silky smooth.
He's a pro.
I say that every time he's not hosting, but man, there's some scrambling that goes on in the background of these episodes to get that damn intro to work. But how's everyone been? This is my first stream of 2023. I know I think we had one last week with a few of the crew, but how's everyone's year going so far?
Pretty good. Quiet so far. Still holiday mode.
Yeah, I'm a lot the same. I don't start my day job again for the year until Monday, so I'm very much in holiday mode. And we were talking before this, I'm going to be very rusty on my best idea for today. And Jack, I think, is making deals happen in Houston. I believe he closed on his small business today. So very well done to Jack if he's watching this replay. But that's why he's not joining us today. But the plan is to go through some of our best ideas. We try to do this every single quarter. So I might just throw it off to one of you guys to give us sort of the first pitch. Any volunteers to go first on this one?
Yeah, I'm happy to take the first one if you want.
Go for it.
So this is one that I actually haven't done too much work on yet, but I think the overall thesis is pretty simple and straightforward. There's not much to it. The company is Alico, the ticker ALCO. If you want to pull it up, Tom, you can. I don't mind otherwise. It's about $180 million market cap, roughly. That might have changed a little bit since the time I last looked. But it's an orange producer in, I believe a lot of the land is in California. They might be based in Florida.
Florida.
Okay, you might be right there. But essentially, it's a company that's trading at a pretty significant discount to their net asset value, or at least their underlying net asset value. On the books, they have a lot of carried value for their ranch land that they own, which they carried about $150 per acre, which is an insanely low price, even just thinking about it. They think that land now, this is management's estimates, are worth between $4,500 and $5,500. They have been selling some of that land and achieving prices close to that, sometimes a little bit lower, sometimes in that range. So I bumped my estimates down to $4,000 to $5,000, just because on the books, that's what I can see they're consistently selling for at least. But they have 74,000 acres of land in total, 49 of which is the citrus land that they grow oranges. That's like their productive asset. That's land I don't think they intend to sell. Little parcels here and there they might, but they're more so buying land on that aspect. And then the rest is this kind of ranch, useless kind of land, which they previously had almost double the amount, but they're down to about 25,000 acres of what they call ranch land. Obviously, the more valuable is the productive part, which management say is worth between 8 and 10 grand, and about half of that again for the ranch land. So on their balance sheet, they have net debt of about 100 million. And if you use management's estimations for the ranch land, it kind of equals out with that net debt position. So for the 25 acres at 4,000 per acre, you get 100 million. So essentially that cancels out the debt. So then you're just looking at the market cap versus the citrus land, the productive assets. And this is where kind of people disagree and change their mind on the overall value here. Using management's estimations, I think it would be worth about 400 million or so for that land, I take a lower figure and say 7,500 per acre, which is just below management's lowball figure. And that gets you to a citrus land value of 367 million and a market cap of about 180. So just on that alone, they're trading at about a 50% discount to their, I guess, underlying net asset value. The business overall, the operating business, is something I haven't done too much work on, but it is a fairly straightforward business. They grow and sell oranges mostly for the brand. I think it's Tropicana. Does that sound familiar to you, Brad, as the only American here? Yeah. From what I know, it's a fairly popular brand, and they're not going to change their orange producer because it would change the taste of their drink. So it's a very concentrated kind of revenue stream, I guess, or customer at least. But I don't think it disappears just because that's changing a product fairly significantly. I don't know how much growth they get out of that, and I don't think it matters too much. As long as they keep on selling this land, the ranch land, the non-productive land, at the value that they say they can, then I think you get a fairly cheap business that deserves some type of re-rate in the future. I can see a question already from Matthias. I can just pull it up. It says, what's the catalyst to unlock value here? That's probably the weakest part of the thesis, I think. I don't know what truly unlocks the value. It could be one of those cases where Michael Burry would say the sheer value is its own catalyst. When the market recognizes this value, I think it deserves some type of multiple re-rate. But of course, that's speculation and something you can't really rely on. So I think to get comfortable with the investment, you'd have to actually like the operating business enough to own that as well, which is somewhere I haven't got to yet. I just find the underlying book value to be pretty interesting.
Super chat.
Huge super chat. Yeah.
Super chat from KK. Thanks for doing this. The value investor community needs something to do on Fridays. I don't know if that's like a subtle dig at value investors that they just have no life and are sitting around with nothing to do. But appreciate the super chat, KK.
Or something to do on Saturdays, right, guys?
Exactly. Yes.
Yeah. I had a question, Frank, about what are they doing with the proceeds as they're selling off these parcels? What's incentivizing them to do that?
Are they buying shrimp farms or?
No, it's mostly just paying down the debt. It's pretty much an exchange for ranch land to debt. That's as simple as it really gets. So you're going to be left with the citrus land or the oranges, and that alone is trading at a pretty significant discount, assuming they keep on selling the land at these prices and just remove that debt, which so far has proven to be true. Just a matter of time, I would think, at the moment.
Yeah, I'm just looking on ticker here. It's kind of volatile, but it seems like standard agricultural kind of returns on equity of like, I don't know, averages out maybe mid-single digits. It's not a great business, maybe, but if you've got that margin of safety from land value, I'm sure that helps.
Yeah, it's not a fast-growing business. I don't know yet if it's a great business, but I think some of these very steady, reliable, predictable businesses could be classed as great. I'm not saying that that's the case in this business because I just don't know yet, is the honest truth there. But yeah, just because it's a low return equity business doesn't mean it can't be really great. But there are other things that stand out where it's a little bit concerning. If you notice on the stock price at about a month or two ago, they dropped off pretty significantly, which is because they failed to make a filing, which was their reasoning. They got rid of their CFO earlier in the year and replaced them in September. There was a report due to come out not long after that, and they didn't have a person in the business working on it. So that's that kind of recent downturn in share price a couple of months ago. So that's obviously a red flag, but theoretically, if you believe what management is saying, this new CFO is now working and in place, and that shouldn't happen again. So that's either an opportunity or a huge red flag, and I guess that's up to you to decide on that one.
Is the founder still involved in the company?
I don't know the answer to that. I don't think so. But yeah, it's a pretty straightforward thesis. It's just trading a discount to what has historically been carried at very low prices, so the book value you would kind of look at is very misleading. You could probably cut that book value in about half, roughly. So it's trading at, or the multiple at least, so it's trading at about half of book value, I think would be around the estimation, maybe even a little bit less.
Yeah, Ticker's telling me it's trading at less than book, I think, with the stated book value. So
cut that in about half is about how it works out, and that would be kind of the true
0.75 I'm seeing at the moment on Ticker.
Yeah, so maybe call it 0.4 times book would be a conservative estimate of what it's really worth. Again, anything could change. I don't think productive farmland is going to drop off a cliff in value. Maybe that growth slows down in an environment like we're in right now, but I don't think it's tied to anything like property prices that could fall off pretty quickly. Productive farmland doesn't seem to decrease significantly. It also doesn't grow quickly. It might stay relatively flat for a long time, but I guess that value is still there, and all they need to do is pay off that debt, and then they're in a much better position.
Yeah. This would be the answer, could be because I know the answer to this question, Frank, but this will be a good one for people to know.
Yeah, how did you find it?
Yeah, so this is a stock that Jeff Gannon from Focus Compounding has followed for a long time. He had a write-up, I think, back in 2019. Even a mention in an earlier write-up a few years before that. Just kind of touched on it, but then covered it properly in 2019. And if you regularly listen to the podcast, you would hear him bring this up all the time whenever he's talking about asset plays. There's a handful, there's 2 or 3 companies he talks about that are in a very, very similar situation where there's this carried book value that doesn't represent the true book value, and they trade at a significant discount. But like that comment we got earlier, the problem is the catalyst. And I think that's kind of Jeff's main hesitation there as well. I'm not sure if he's ever owned the stock. Usually they don't talk publicly about the stocks they own. And he still talks about it recently, which would imply they don't own it yet anyway.
Yeah. Jeff, otherwise known as the American Frank Tabor.
I wish. High aspirations for that.
Is he the one with the beard?
Yeah.
Yeah, okay.
Just about 500 times smarter is the only difference.
Well, you're more humble, Frank, so I'll give you that one.
Guys, I wanted to ask, what do you think about asset plays in the portfolio? Something like this, something that the value might take a while to come to fruition. Like, do you like to have asset plays in the portfolio, or just stick to stuff like Seritage where we know when things are going to play out?
Yeah, I was about to say that there's probably a few learnings from the Seritage situation, which like the margin of safety turned out to be quite real, I think, in the Seritage situation. The trouble with Seritage is, again, they, at least up until the past 6 months or so, didn't have a catalyst for that value to become kind of real, other than, if they were to get to like a cash flow positive situation. And you had the kind of cash burn as well, which was probably a major reason for the discount. So I don't know. Seritage is the only one in my portfolio at the moment. I'm not sure if you guys have invested in any other stuff like that.
Yeah, I'm pretty attracted to asset plays in general, just as they kind of have that downside protection that a lot of other investments don't have as much of, at least. But again, you need some kind of catalyst, whether it's an activist or some kind of buybacks or liquidation, or something happening where that value is going to be realized for shareholders. And sometimes an asset play like this, trading at a 50% discount to book or to net asset value, can just continue to trade that way for the next 10 years. And then you only have this really slow return on equity, real low single digit kind of return you would probably get if there's no realized value, at least. But yeah.
I know I've read somewhere that a lot of railroads have, like, they own a lot of land and they own mining rights and all sorts of water rights and everything, and they tend to become asset plays, and the value doesn't get capitalized until like way into the future, or sometimes even never until they're publicly listed. So
yeah. I mean, the trouble with stuff like this is the I mean, like agriculture is right in my wheelhouse. Oranges specifically, not so much, but they've all got kind of similar characteristics. It's just they're very low return on capital businesses, and I don't know if there's some sort of special contract here with that juice company you mentioned before, but more or less more or less commodity prices in agriculture just come down almost within range of the cost of production, like enough to make a few people want to be in the business and earn like really mediocre returns on capital, but they don't tend to get a lot higher than that. So I don't know if you buy so you're probably talking maybe normalized like 5% returns on capital, something like that in most like farming type businesses. The helpful thing here is you're buying it at a big discount to that asset value, so your yield as an investor might be higher, but it's tough if they're just taking that cash and reinvesting it in relatively low yield assets. I don't know.
I guess kind of underlying that though is the increasing value of the land that they own on most of these kind of agricultural plays. So I guess that's like an underlying return that might not be getting recognized, but you should see in a share price at least. If management do a good job of kind of making the market realize that that's happening, which historically Alico have not done, but have started to recently.
Yeah.
Tom, do you see a lot of vertical integration in agriculture, or is it like, separate and stuff, or do companies like to have sort of that model?
Yeah, I see what you're saying. I would say things like cooperatives are much more common. So, you might have small individual family farmers kind of band together and have ownership, like fully farmer-owned milk processing company like Fonterra is an enormous business in New Zealand, which is an example of that. I think that type of model is more common. Maybe if you get really, really large scale farms, they can start to build their own processing plants and that type of thing. But it really is a game of like scale and efficiency. So you often see, you don't see a lot of it. And if you do see that type of stuff, it's farmers banding together in cooperative type structures. You have to be a farmer to be a shareholder sort of thing. And there's a few of those that are actually publicly listed in New Zealand. So yeah, but you got to be a farmer to own it, or I think Fonterra, for example, you can own as an individual investor, but there's not too much advantage to it. Like you become a Fonterra shareholder so that you can get the benefits as a farmer of supplying Fonterra and in theory getting the highest possible milk price that you can. Whereas if I'm just an individual investor not running a farm, like all I benefit from is the dividend, and there's a lot of cash that's reinvested in the business and that type of stuff. Like a lot of farmers would prefer cash to be put towards a higher milk price rather than a lower milk price and then a bigger dividend at the end of the year, which might benefit the non-farmer shareholder a little more. So a few nuances there, but that at least in New Zealand, I don't know about other countries, but at least in New Zealand, that's how it's generally approached.
I was just considering this to be possibly a buyout target, so that was where the thought was coming from. Yeah.
Possibly. I don't know if that is. I don't know how big that juice company is, whether it's something they might buy. Don't know enough about it.
Because I know with McDonald's and stuff, like they don't own a lot of the chicken farms and stuff, but they kind of have contracts in place where they control without owning. So it might be the same thing for the juice company here. So
I wouldn't be surprised. Like, I don't know, that McDonald's would earn far more money opening a new franchise restaurant than investing in farmland, I suspect. So I imagine the juice company's probably got similar views, but it's all just wild speculation, really. Cool. Anything more on that one, Frank?
No, that's about it. I think it's a fairly straightforward thesis, pretty boring old asset play, but yeah, that's about it. Who's got the next idea for us?
Well, maybe just one last question before we move on, Frank. Like if this is one that you personally would look into more, what are the next kind of things you would look at? Is it just paying a bit more attention to the underlying operating business and?
Yeah, but more so, what is the operating business? What's that going to look like in the future? Is it a good business in the first place? I would have to understand management a little bit more. what I've kind of outlined today is just what attracts me to an idea, I guess. And then that's where the work starts to see if the rest of the business and everything else kind of matches what I'm looking for. And that much I don't know yet. But to understand that Orange business and their relationship with Tropicana and then management, that'd be the next steps I would take, I guess.
Cool.
Yeah, Tropicana is pretty big, right? I mean, I think you see it
Yeah,
in a lot of
really
countries. Yeah.
Mhm.
Yeah.
And I can't drink it. It totally wrecks my stomach. I don't know if it's too acidic or I need the fresh stuff personally. I'm a delicate flower, so.
It's all the preservatives.
You make it yourself, Brad, or not?
Do I make it myself? No.
Okay.
I'm surprised
Yep,
Brad
yep.
doesn't grow the oranges and like
Yeah, I was gonna
from
say.
I would. They don't grow in Asheville, so it's too bad.
Yeah. Are there any
What
other
have you
sort of
been growing?
juices you could work on?
Apple juice for sure.
Okay.
Yep.
Nice. So do you get the red apples or green apples?
I get more specific than that. I can't handle
Oh, no.
Fuji. Everybody eats Fuji, and I don't like Fuji at all. I'm a pink lady guy. Pink
Okay.
lady. Yeah.
Cool.
Check
We've
it.
opened up a can of worms here. We have to stop Brad before he talks about
I know. You got to be careful.
agriculture
Can
all
of
day.
worms.
Yeah.
Good fun there.
So Brad's pitching pink lady apples today.
Mhm.
No, Brad, what do you got for us? What's your best idea?
Yeah. Well, I'm going to go a little bit on a tangent here. So I was listening to a podcast, the Richer, Wiser, Happier podcast. And it was, who was it? It was John Spears. I'd never heard of John Spears before. But apparently, he was involved in some early deals with Buffett and Munger. He had some great stories to tell. But something that really stuck out to me about that podcast, he was talking about the pond that he likes to fish in. And the pond he fishes in, he looks globally where, top insiders have bought recently. So like high level C-suite. And so that's the pool that he fishes in. And then he stratifies based on how cheap versus how expensive it is. And, in the top decile, he's talking about how that really outperforms the S&P over time. And so that's where he fishes globally, is where there's recent strong buying activity. So, I decided to run a little experiment for myself. I looked at the ideas on Value Investors Club from January 2020. Okay, so going back about 3 years. Because in Open Insider, that's about how far back I can see insider activity. And there were like 22 ideas that month. I think 7 that had big insider buys, kind of just before those write-ups were done. And it was just like he said, it was like 22% annualized returns for those 7 companies versus, I think, 15 if you had bought the whole month, all 22 ideas, versus like 5% for the S&P 500. It hasn't done great over the last 3 years. So that kind of piqued my interest, and I looked more recently at VIC ideas and kind of dug into where the insiders were buying. And unfortunately, none of the ideas were really in my wheelhouse. It was like pharmaceuticals and retail. I was just like, yeah, nothing really tickles my fancy here. But this morning, I listened to the All In podcast. You guys All In podcast regulars? Come on, Chamath. You got
Hell
Chamath.
no.
Yeah, well, I saw one comment here that made me think somebody's listening. And it's mostly entertainment, right? These guys, they're just coming out of such different fields in terms of where they're coming from, thinking about these investments. But David Sachs kind of caught my interest talking about U.S. liquefied natural gas, kind of the tailwinds there because of what's happening with Europe's supply of natural gas. They got a lot of it from Russia, and that's been cut off. And so I went down a little bit of a rabbit hole on the LNG. Actually, I thought of Massive Capital. I know some of you follow Massive Capital. And in their Q3 letter, who is this? Will Thompson says, we continue to like the idea of liquefied natural gas exposure, but have yet to find an opening or opportunity. So, it'd be interesting to see if there's anything out from Massive Cap for Q4. But the thing I did dig into a little bit was self-storage. So I was, digging into a different podcast, and the guy mentioned he's big into self-storage and car washes, and he's talking about how self-storage is a great business during a recession. And he went on to say, during a recession, people are downsizing, right? They're buying smaller apartments, smaller houses, businesses are downsizing to cut costs, but they usually don't get rid of all their crap. So it's a real boom for the self-storage industry. And actually the only self-storage company that had a recent write-up in Value Investors Club was a self-storage in Australia, NSR in Australia. But there's two in the US that look interesting, NSA and PSA. Fairly high dividend yields at the moment. They don't look very cheap. I think a lot of people appreciate how powerful the self-storage business model can be. But yeah, those are some rabbit holes I went down. I don't know if any of you guys have looked at self-storage as an investment. Karan?
Not at all.
No. It's a new one for me.
I don't get the concept of hoarding stuff. Like, yeah.
Is that less of a thing there?
I mean, yeah, I just haven't seen it around. It's something different for me.
Oh, it's big in the US. I imagine it's big in Australia as well.
Yeah, definitely.
Have you looked at NSR before, Frank?
No, I just pulled it up to kind of check what it was, actually. I've never looked at it.
Can we pull it up here?
Yeah, can do. I've got it.
It just seems one of those, it's like the stereotypical Australian stock that just pays a pretty big dividend, stable kind of business model. So it just depends what you're into, I guess. I don't know how much more attractive it could get than a very slow return with a 4 or 5% dividend yield. Which if you're in Australia, the tax benefits of that are pretty good. I don't know how franking credits and stuff look for global investors investing into Australia, but this is what a lot of the money in the Australian stock market go towards, is just these. A lot of the baby boomers just have all their money in these high dividend yielding stocks in Australia and live off their retirement with companies like this. So it just seems like another one of those. Could be wrong though. There could be a lot more to it.
Real quick, Jay, and
Quick
thank
break.
you for the super chat.
Yeah.
Thanks, Jay.
Tom saw it.
Yeah, thanks,
Awesome.
Jan. Happy New Year, guys. Thank you for all your teachings, wisdom, and ideas you all provide. Thank you very much.
Oh, just to mention, so this was a year and a half ago that this one was pitched. It was at $2 Australian, and he thought there was like 20% upside, so up to 250. So, not a super compelling pitch from my perspective, but perhaps still has a little bit of room.
I don't know why people bother writing those things up.
Well,
That's like I think Lee Lu said something about those types of write-ups. That's like margin for error rather than margin of safety, something like that.
Right.
Yeah.
Right. Yeah.
Does Tick give a dividend yield? I don't know if it does it?
Yeah, in the valuation section.
Okay. Whereabouts our dividend yield?
Yeah, so about 4.5%.
Yeah, running in the 5s for
4.5,
a few years. I guess
So,
got more expensive recently.
nothing to sneeze at, 4 or 5%.
Yeah, particularly in Aussie, if you're an Australian investor and you can get some of the tax benefits of that. Actually, I guess if it's a US REIT, you'd get that as well, specifically because it's a REIT. So that helps. But yeah.
Yeah.
So what about LNG? Is that something you're going to be looking into, Brad? Or
It's not really in my wheelhouse. It's not really something I'm interested in owning. But seems like it could be an interesting space to find value for those of you who do look in the energy space. You play a little bit in the energy space, right, Karan?
well, no, I mean, not anymore.
No.
I clearly don't know what I'm doing there, so
I see.
it's like,
Yeah.
Have you been in energy before, Karan?
so yeah, I mean, I was briefly in Gazprom, which in hindsight is like the worst place to be. But then when I heard about tanks pulling up and everything, I'm like, okay, yeah, clearly I have no idea what I'm doing, so just exit, get out.
Yeah. Fair enough.
I mean, it
Have you
looks
been-
cheap, but I mean,
Have you ever
If you
had any nuclear exposure?
I don't know if Gazprom counts, but I mean,
It looks radioactive from here.
Well played, Tom.
Speaking of energy, should we move over to Tom?
Yeah, I clearly haven't been keeping up with the punch card streams that I haven't been present at, because apparently this got talked about a couple of weeks ago. I really have just been my camera's gone all blurry. I really have just been fishing and on the beach these past couple of weeks and haven't been thinking that much about stocks. But
Congratulations.
Yeah, well, thank you. I have been scrolling Twitter a little bit, and something I've seen thrown around a bunch is coal, specifically in Australia. Whitehaven and Yancoal, I guess, are the two that are getting thrown around there. So Yancoal's piqued my interest. It seems a little like kind of the oil thesis in a way, but on steroids, where I guess the oil bull case is like people think oil prices will be higher for longer. Valuations are kind of modest, and you're getting a lot of cash back out the gate. And coal seems like all of that over again, I guess, but much more extreme. Like the coal price has really gone parabolic in the last year or so. Something like Yancoal specifically, looking at some people's estimates, could maybe be close to a PE of 1, although definitely doesn't look that cheap if coal prices come back down. And they have a pretty well-defined dividend policy. And again, the bull case out there is that you could be getting like 50% of your money back, say, in a dividend yield over the next year. So that's the very rough thesis and something that I've looked at. For now, it's kind of in the too hard basket. I just don't think I understand like the ins and outs of the coal commodity particularly well, but I'm still kind of looking at it. So
why have prices gone parabolic? Do you have a sense for that?
I'm not sure if Frank or Karan can maybe speak on this as well, but I think it's basically to do with the energy crisis and a little bit of demand coming off from a bit of supply coming off from Russia, I think, and possibly some switching of energy sources, but I don't know the details of it that well.
Yeah, that's what most people speculate is the reason behind it was the Russian situation. And then the exports for most US coal companies over here goes up pretty dramatically. But yeah, I think that's the most of it. I think maybe I'm wrong, but I think coal prices went up about 4x over the past year or so.
Yep. Yeah, from about 100 a ton, or maybe even slightly below that pre-pandemic, to like 400, maybe even a little more.
Yeah.
We've got a question from Luis. What's the ticker? So Yancoal is YAL on the ASX, and Whitehaven is WHC. There's a lot of particularly Jeremy Raper on Twitter would be a good person to follow if you're interested in this type of stuff. He's put up a lot of his thoughts and analysis around upside, downside, and I guess the disparity in valuation between those two. There's a few red flags with Yancoal. Like I think it has something like 90% ownership from a single Chinese shareholder. Does that sound about right,
Wow.
Frank?
I don't know how high, but it's a significant ownership from a Chinese shareholder.
It's up there. Yeah.
62%, it looks like.
Is that right? I thought it was higher. Possibly there's a couple of different shareholders if you had them
Yeah,
together.
that could be.
Yeah. Which is basically, that's one of the reasons why you're going to get your capital return in a dividend, whereas Whitehaven is doing quite a substantial amount of share repurchases instead because they don't have that issue. But Whitehaven does seem to trade at quite a premium to Yancoal now, which it always has done, but it seems like that premium's got a whole lot wider more recently. So
I think even the type of coal that they have is different, right? Between
they have the Whitehaven have the Newcastle coal, which is just like a higher grade coal essentially that sells at a higher price. So in Australian terms, I think most of what Whitehaven would sell would be around the $380 range kind of thing, where I think Yancoal collects a little bit lower than that, around $330 or $40. But yeah, not all of their. So Yancoal sells a few different types or grades of coal, I guess. So they kind of collect a different range in there and average out to be about that 320, 330 maybe, Tom. I don't know exactly.
Yeah, don't off the top of my head, but I'm pretty sure like this argument gets thrown around a lot that Whitehaven's selling higher quality coal than Yancoal. And if you look at it in terms of like average price and average quality, I think that is correct. But I think of the Newcastle coal, I think Yancoal actually sells more Newcastle coal than Whitehaven. It's just they sell other types of coal as well, which is lower quality.
Yeah, okay. Interesting.
Yeah, so.
But yeah, I guess the main difference between the two is the buyback versus dividend policy, and which would be more attractive. Yancoal could also have a multiple re-rate, which is what Jeremy Raper is kind of more attracted to than a white coal that is probably more built into their multiple at the moment. But yeah, I don't know which. Are you leaning more towards one than the other, Tom, or is this something that becomes a basket play?
Yeah, I'm probably leaning towards Yancoal just because you get assuming that the thesis is correct on how much cash Yancoal is currently generating. It seems like you're going to get a whole lot more cash out of the thing sooner, and it looks cheaper.
Yeah, well, the appeal to, I guess, Yancoal, and I don't know the kind of capital allocation policies at Whitehaven, so they could be on a similar path here, but you almost get the 25% yield on a dividend, roughly. That's got a bit of wiggle room. That's almost guaranteed. Even if prices fall off now, that money's already been made. So it's kind of just a waiting game for management to announce how much they're going to pay in the dividend. It's expected by most people to be around the $1.50 range. A lot of people on Twitter kind of talk about the over-under on that $1.50, but you can average it around that. I don't know the exact share price right now, but last time I looked, that would have been about 25% yield. And I would assume Whitehaven's doing something similar with a buyback where they also have earned just as much money, and assuming their capital allocation policy is to buy back that amount of shares, they should have a buyback yield just as high as the dividend yield at Yancoal, or at least within the range of.
Yeah. Just for reference, these are both trading at an EV/EBIT of like in the twos. And again, one of the arguments here is that coal prices for the back end of 2022 are kind of known at this point, and Yancoal should have produced like a ridiculous amount of cash in that time that they haven't yet reported. So the enterprise value is probably overstated in this. So it's likely well south of 2, I guess is what I'm saying.
But is this normal for like coal producers? Like, is this similar to what you see in the US, or is that something either of you've looked at, or not so much?
I've really just looked at the Aussie ones. Frank, do you have anything on that?
Yeah, no, I've never really looked at coal at all until these two companies specifically. Yeah, it's definitely not something I understand well, but it is interesting.
Yeah.
Are there any other accounts that you've come across apart from Jeremy who kind of gotten into Yancoal? Or
there's a guy named Yellow someone. He calls himself the Koala.
That's what I was going to say.
But he leans towards the Whitehaven side. He's kind of an expert in this space. He's done a good podcast with Yet Another Value.
Just Another Value
podcast, whatever it is. What's his name? I'm blanking on his name.
Andrew Rangeley, is that it?
Yeah, Andrew Walker. That's his ticker
Andrew
though
Walker.
on Twitter. Yeah, but yeah, they cover it really well and go over the whole kind of coal thesis. And there's a question on there where they talk about the difference between Yancoal and Whitehaven. He strongly leans towards Whitehaven, whereas Jeremy Raper would lean towards Yancoal. But you see those people on Twitter that kind of say, why not have both? There's no reason to pick. They're both interesting. They both benefit from the same kind of catalyst, I guess, that they've got this ridiculous amount of cash flow right now and have to do something with it. So, yeah.
So it's at Yellow Lab Life on Twitter is the koala. And a lot of his tweets, he actually starts out by saying the koala has been thinking about this, and then it's pretty funny. And he's fully blurred out, I think, in Andrew's podcast episode with him. Like he's quite undercover, but he's some sort of ex-commodity analyst who I think is now just a private investor or possibly runs a fund.
Another great one to follow is Respeculator. Respeculator. He's another kind of coal expert or commodities expert, I guess, in Australia.
Yeah,
as well. And he leans towards the Yancoal side, from what I've seen.
Yeah,
does Sven talk much about coal? You guys follow?
No idea.
Not that I've seen, but I may have missed it.
What about Josh Young? Is it? He's into oil, right? Is he also?
He's an
pretty
oil
much
guy.
Just oil. Yeah.
Just oil. Okay.
Oil and gas is like what his fund is focused on.
Yeah. The other thing I was going to mention here as well is that if assuming this all plays out as the likes of Jeremy Raper are thinking, and you get these huge dividend payments, the franking credits from Australia for Australian investors will be very beneficial versus people investing from other countries, including myself. Unfortunately, I won't get the benefit of franking credit on an Australian dividend,
and that's why Whitehaven becomes a little bit more interesting, maybe too.
Yeah, exactly, because you're getting your return through repurchases and presumably higher share prices. Yeah. Just blanked on the other thing I was going to say. And the large ownership of those couple of shareholders in Yancoal apparently turns off a lot of institutional investors. So I guess, I don't know, that people are trying to argue all sorts of reasons why there's the valuation disparity, but that's just another thing people kind of throw in there.
I'm guessing Yancoal is very illiquid too. I don't know the market cap, but assuming those shareholders, the public float would be very low.
I think it was 180 million.
No, it's much larger.
Oh,
it's
5.5 billion. Yeah, it's much bigger.
Yeah, so then I think if you have 90% or whatever that's in Chinese shareholders, then you have a very low public float. So it's a lot more liquid than it probably appears.
Yeah, I'm seeing more like 8 billion, but it's in the single billions somewhere around there. Yeah, that's Australian USD. Dollars.
Yeah.
So the float would be something around, call it 500 million or so, which would keep a lot of institutions out as well.
Yeah.
Cool.
Is this a space you'd like to dig into more in the US market, or maybe in other markets like, I don't know, where else do you get coal from? Like South America or
Russia?
Well, I mean, countries you can invest in,
Australia is right up there, I think, in terms of percentage of global coal production. But
following that Guy Spear model of like different countries, if you find a good business model, that's kind of what I'm thinking.
Yeah. I guess I kind of naturally just get pulled towards Australia because it's commodity stuff, which Australia
is the low cost producer. Like, do you find low cost producers in Australia? Is that
couldn't answer that question well.
Right.
No, don't know.
It's a top 5 producer. Australia is. China, India, Indonesia, US, and Australia, top 5 coal producing countries by volume last year.
Yeah, and actually something else I was going to say, now that you mentioned that, Brad, is I believe the the energy content of coal from those different countries can be quite different. So although Indonesia, for example, might produce a certain percentage of the world's coal, I believe Indonesia specifically is quite a bit lower quality than like a Whitehaven coal. So yeah, that impacts price and a range of things.
In terms of energy density, I'm assuming you're talking about.
Yeah, exactly.
Yeah.
So I don't know. This is where I'm really struggling with it. Like, it's just something I'm trying to force into the circle of competence, but a long way to go, I think. So that's what's held me back from touching it so far.
I might just pull up this comment just because I'm interested to see how you guys think about something like this. The Art of Value says, could not own coal from an ESG perspective, to be honest, in 2023. Is that something you guys consider at all? I know some of us might more than others.
Yeah, I don't think I've ever invested in something where that's really been a concern. This would probably be the first time if I was to get into it. I don't know. I like the idea of investing in a way that's aligned with your values, but also the stock market's a secondary market, and it's not like I'm providing Yancoal with capital to produce more coal. I don't have a good answer, honestly. I think it's quite an individual thing.
You can make money on Yancoal and then contribute to it.
Sure. Go plant some trees. Yeah.
Yep.
Yeah.
It's probably a better way to go about it.
Yeah. What do you guys think?
Yeah, no, I don't. I think there's a lot of pros and cons to an ESG movement. I think it's probably somewhat problematic, and I guess a little bit of wishful thinking at times. And I know, at least when I'm putting my money towards something, especially like Tom said, with the amount of capital, I don't think what I'm going to do is going to impact the greater good of the world in any way whatsoever at the moment. So yeah, I have no problem owning anything from coal. The only one that kind of would make me hesitate would be tobacco, but I've spent time looking at tobacco companies in the past as well and was interested for a little bit there. But yeah, I don't know. There might be a couple of companies out there that I wouldn't invest in, but most of them I'm pretty open to, at least.
How about Coke and Pepsi whilst owning Burger King?
Bill Ackman, that tweet is just, he is trying to make himself hated, I think, at this point.
He's trying to get them back in the buybacks. That's what he wants. He wants.
Well, that's what it is. He's trying to depress the stock price.
Of course. I feel like every month or so he has to put out one tweet, that kind of makes people question, like, is everything okay? Like, who's he supporting?
Well, he first brought it up at the Ted Weschler, whatever that conference was, that interview was. He asked the question. Yeah. Todd Combs, so same person, same type of person.
It's like Frank and Jeff. It's a whole thing.
But yeah, he kind of first pitched it there, and kind of it was weird at that time, and then he doubled down on Twitter with a lot of public comments on Coke and Pepsi. Just for the people that don't know, he owns, I think, about 70% of his portfolio. His top 4 positions all in some way have a deal with Coca-Cola or Pepsi and sell the products. And then he's owned, of course, companies like fast food, Domino's and things like that, that are arguably just as detrimental to global health, or at least in the same ballpark. So to come out and really be public about that is so strange to me. But
he brought Burger King to the public markets, right? I think.
I'm not sure. Maybe. I don't know his history too well,
and stuff. That was the whole thing.
That was before the woke moment, Karan.
Yeah, there was a whole Restaurant Brands International. That
he wasn't woke yet. Yeah.
He pushed it through. Yeah.
Yeah. Burger King sells Beyond Burgers now, though. So are they selling ESG?
There you go.
I don't know.
Do you guys have those?
Sure. I haven't.
Yeah, we
haven't tried one yet.
I haven't tried one now, but I've heard.
I'd give it a go, but the reviews I've heard haven't been stunning.
Yeah, I had a bite. It was not great.
What was it? Sorry, I was reading.
Beyond
Meat. Yeah.
Beyond Meat. What is it even made of? Is it soy? Is it mushroom?
Burger.
What is it? I think that's similar.
Someone in the comments can tell us what those things are made of.
A bunch of random sweet
I
products.
think, Brad, if Tropicana is not like good for you, I don't think the Impossible Burger is going to work too. Yeah.
I don't think so.
I spent some time as a temporary vegetarian back in the day, so I consumed. I dabbled in being a vegetarian. My partner was for a while, so I dabbled. I gave it a try, I'll say.
What made you stop? Out of curiosity, Frank.
Mostly just missing out on.
lack of
firstly,
meat.
I didn't have the
You're starving.
moral. Like I think what keeps most people there is the moral kind of undertone of not wanting
Sure.
to harm animals, which it wasn't in me. Not to say that there isn't some things that could be done, but I guess that philosophy wasn't keeping me there. There are environmental arguments and things like that to it as well, but I just didn't have anything that really wanted to keep me there for long enough, and I just missed the good food.
Okay.
Yeah. It's interesting. Like, I know Buffett seems to increasingly get asked about ESG and the types of companies he'd invest in. And I think he said something about the tobacco companies before where he would buy the stock, but not the whole company. And he said that he kind of put out there that he knows that doesn't make a whole lot of sense, and you can question whether it makes any sense or not, but that was kind of his view. It's a really tough one. I don't know.
There was some issue, right, with Berkshire and ESG and everything, I think 2 years back.
It's every year,
group
just
of
about.
shareholders. Yeah. And he's like, Berkshire's doing a lot more for ESG and everything than people realize. He really got into it. Yeah.
Yeah, I think the issue was they wanted Berkshire Hathaway to publish a group level kind of sustainability report, whereas Buffett didn't want to impose that on all the subsidiaries. And the likes of Berkshire Hathaway Energy and the railroad, which probably contribute a very large chunk of Berkshire's emissions, already have a lot of kind of strategies in place for that. And I think if you go to the latest Berkshire annual report, I mean, Greg Abel, I think for the first time this year or in 2022, wrote a letter in the Berkshire annual report, and there were some carbon emission kind of components of that, which have been pretty impressive. I don't recall the reductions on the top of my head, but yeah, it's not like they're doing nothing. They just didn't want all the paperwork, I think.
I think carbon capture is also a huge part of the investment case for Oxy, OXY. So I think now they own like 26% of the company. Does anyone know?
It depends if you count the warrants or not.
Warrants.
It's pushing 30 with the warrants, but they haven't been exercised, at least last time I checked.
So yeah, I mean, that adds to kind of Berkshire's ESG at this point, because they pretty much own a quarter of the company. So
yeah, we'll have to see how it plays out.
So we've been pitching a lot of stuff like oranges and storage and coal.
Yeah,
so let's hear yours, Karan.
I want to keep it in that same trend and kind of pitch a telecom company. So the company that I've got is Liberty Global, and ticker is LBTYK or LBTYA, depends on which class of shares you're interested in. Funnily enough, there's a bit of a discount even between the share classes. I have no idea why that exists, but it does. So
Different voting rights or no?
voting rights, yeah. So the one with the voting rights actually trades at a discount, which you would think, wouldn't make a lot of sense, but
markets are efficient.
So yeah, with Liberty Global, you've got it owns a whole bunch of telecom companies. They own Virgin. They have this joint venture with Virgin Media O2 in the UK. They've got Vodafone Ziggo in Netherlands. They've got Telenet in Belgium. Few companies here and there, right? So the main idea behind this is the buybacks. So the company, it's been continuously buying back a lot of shares, and since 2017 they've bought back up to 50% of their outstanding shares. And last year they plowed in around 1.7 billion into buybacks, and initially it was actually 1.3 billion, but then they saw that the stock price was a bit depressed, so they increased it by another 400 million or so. and this is on a market cap of around, I think around 9-ish billion or so. So, this is going to be a significant contributor of value for the company, and that's pretty much the idea behind it. Buybacks, and keeps going on that way.
Is this pretty classic? Yeah, I guess it's pretty classic John Malone of just trying to shrink the equity and.
Oh yeah, there's a lot of debt in there. So they've got like around 16-ish billion of debt, 3.6 billion in cash or so. And yeah, they've been like funding the buybacks with a lot of free cash flow, but that's pretty much what they intend on doing. So the debt is all fixed rate, long term. I think the debt maturity is like 6 or 7 years out on average, and average rate is around 4%. So good place to be, yeah.
So what kind of buyback yield or something are you looking at here, I guess?
So it varies per year, but on average, they buy back like 10% of the outstanding shares. And the business itself is growing slightly, and they are probably going to expand. And especially in the UK, like they've been investing a lot. So we'll hopefully see, an impact on the free cash flow of that, yeah, later.
How much is like the buybacks coming? It's essentially just an LBO, right? In a way, or is it coming from free cash flow more than I think? How much
No,
do they
so
buy
I mean,
back
it is
for
being
debt versus free cash
funded.
flow?
It is being funded by free cash flow. And even the debt, I mean, it's not on the parent company. The debt is held individually at each of the subsidiaries. So at any point, suppose they decide to sell off a subsidiary, they can probably meaningfully reduce that debt. Not as much of a concern. Although that's pretty much why the market doesn't like this company, because huge debt, and it just seems bad at first glance.
And so what did you say the kind of yields on that debt were, the terms of those debt?
4% fixed.
4.5%. Average maturity 6 to 7 years.
Okay.
From what I can see, it looks like revenue is trending down a bit. Do you know what's happening there? Are they divesting their less profitable businesses, or what's going on there?
So depreciation is a factor that they have here. And I mean, with the revenues, I think they've been also reinvesting a lot, and it's not as much of a concern. Yeah. Again, like with most of John Malone's companies, you focus on the free cash flow, and yeah.
The rest will take care of itself.
Have they done spin-offs in the past? Is that where I know there's a branch in South America, the ticker is Lilac, Lilak.
Mm-hmm.
Is that a spin-off from this kind of parent global company, or no? Is that separate entities completely?
I think they're all John Malone affiliated companies, but yeah, that's all I know about the other company, Lilac.
Yeah. Because that one came on my radar, which is essentially the same kind of thesis.
I think Michael Burry's into that's for the South American market, right?
Yeah, and it's the exact same thesis. It's just got a little bit of political risk attached, so it's a bit cheaper, from what I understand. But yeah, the same idea of these buybacks taking place.
We've got a couple of comments, Karan, about super investor support, and was Berkshire previously an owner? Do you know anything about that?
Ted or Todd?
Berkshire being an owner, I'm not sure. No.
Okay,
that's pretty right. Sure. I remember it being in that portfolio.
There was one of those really small positions, the Ted or Todd type positions, in one of the Liberty branches. I don't know which one.
I have seen Liberty something in there a couple of times, but couldn't tell you which one. There's so many.
Liberty Properties, yeah.
Yeah, okay.
Yeah, and they're in Liberty Sirius XM at the moment.
Telecoms in general are really cheap right now. Is there a reason that I don't understand, never really looking at the industry, of why they're all kind of fallen off a cliff? I'm not sure if Liberty has. I just seen Charter brought up in the comments.
I think, yeah, broadly, I mean, people haven't really been as fond of telcos so far. But I think with the whole change, the whole 5G and fiber and everything, like I think that might change in the future, and that's possible. So multiple re-rate is kind of a possibility, but not something I would really count on as much. Basically, just go with the buybacks and see how it plays out. Yeah.
So Liberty is Seth Klarman's largest holding. So that's interesting.
Which
For
one?
his stock portfolio, yeah.
Mr. Margin of Safety himself.
I think he owns both. He owns Liberty Class A and Class C also.
Yeah.
Michael Burry, I just brought up the comment. I haven't fact checked this, but the last NF owns 3 Malone companies. I know
Curate and
that I think Lilac might have been one in there as well. The South
Lilac,
American
Curate,
one.
and Charter, I think.
Yeah, I'm just seeing Berkshire has at least 5 that I can see in their 13F. It doesn't look like this is one of them though. And they've also got a position in Charter, but they're all small. They're gonna be
Charter is
cheap
like
to
a
dodge.
FinTwit favorite, I think. Like I see it all the time.
Yeah,
Yeah.
So a few deep value stocks today. These
Well,
really cheap things, I think.
Charter just started getting recurring payments from me, so they've got quite a strong
they're going to the moon.
monopoly position with internet service. Yeah,
Nice.
I may have to take a deeper look at them now that they're
How's the experience and why Charter?
hit and miss. Charter because they were the only option for high-speed internet where I live, so it's pretty easy.
Right.
Karan, is there a reason why this Liberty business in general, rather than or any other John Malone businesses, I guess in general, why this specific one?
I was just looking into it. Seemed interesting. Dug into it, made a lot of sense. I like the fact that the debt seems, makes it look kind of ugly at first.
Doesn't
and then you dig
screen
into
well.
it. Yeah, exactly. So it's fantastic. And when you actually dig into it, and I've used Sunrise and a lot of the other services, and I was like, okay, I was pleasantly surprised that they have a good product. Yeah, seems interesting. Stuck into it. Yeah.
Cool. Anything else to add on that one, Karan?
That's it. I mean, I think I've got 2 companies in the portfolio that do buybacks. One is Process and the other is Liberty Global. So, I mean, it's kind of, it works from a portfolio allocation kind of basis. It's relatively slow growth, but it's kind of consistent, good downside protection, reasonably low chance of permanent loss of capital. So yeah.
Cool. Nice. I'm just going to throw out one bonus stock while I'm thinking about it, because it's one that's been on my watch list forever and has never been cheap enough, and for me probably still isn't. But I'll just throw it out there, which is ARB, listed on the ASX. Is this one that you've come across before, Frank?
What's the name of the company?
ARB.
That's the
I
name.
haven't.
Wow.
No.
Okay. Yeah, they do 4-wheel drive accessories. So they do, bull bars, snorkels. If you ever see a super Australian looking Land Cruiser, that they've probably spent a bit of money with ARB. And it's actually quite like Thor Industries-esque, where it's a somewhat cyclical business, but pretty good returns on capital. It looks like they've, over the past decade or so, grown maybe on average around 10% a year. They sort of suddenly grew about 34% during the pandemic and are still growing double digits after that. Have averaged around the 20% kind of return on equity mark. And it's down about 50% from its kind of slightly post-pandemic highs. Still looks a little expensive for me, but really, really strong brand, like super popular in Australia and New Zealand. So that's one that's still on the watch list for me.
I'm just looking at the stock price. It went pretty parabolic after the COVID crash, from 14 a share up to 52 per share. Is the kind of recent sell-off just the market re-rating something that got too expensive, or like on a historical basis, is this actually cheap, or is it still maybe at a premium too?
Yeah, I tend to lean but towards it still being at a premium. I think it got super expensive. I'm just trying to pull up some of the valuation stuff here. I'm going to share this.
Even I was just looking at the EV to sales multiple. It seems they've got a lot cheaper than this, but they may be at like the 10-year average multiple at the moment.
Yeah, so EV EBIT of 13 at the moment. Mean of as far back as I can go is about 16, not quite 17. Still trades at like 4 times book, which is expensive, but yeah, it's come down a lot. Like it was 40 times earnings and like 8 times book or something at one point. Looks like it peaked out over 9 times book, so it's come down a lot. Pretty good business. Yeah.
Is this a personal interest bias from you, Tom?
I haven't spent a lot of money with ARB. My girlfriend's dad has spent a lot, and a bunch of friends of mine have spent a lot with ARB. Like it's known as being a pretty premium, like super high quality 4-wheel drive kind of accessory brand. I think it'll grow for a long time. It seems like they're still pretty Australia, New Zealand heavy. So just one that I've been following from a distance for quite some time and has come down. But yes, it's probably the answer.
Where's the growth come from? I'm assuming they've probably got is it new markets? I'm assuming the Australian market's pretty covered by now.
Yeah, I think new markets, I'd have to refresh my memory because this really just sprung to mind like 5-10 minutes ago. But I believe they made a small acquisition in the UK, I want to say, as well in a related business. So possibly some acquisition. But yeah, I don't know. Anytime I look at some of this stuff, I'm sort of like, Thor is very similar and it's way cheaper, so I just sort of stop.
I was just waiting for a Thor pitch. I was like,
yeah, I almost did it today, but I've held off for an hour and 7 minutes. So. There you go. Should we take some questions?
Yeah, let's do it.
Yeah, cool. Yeah, if people have questions, pop them in the chat. Are there any straight off the bat you guys want to tackle?
Question of mine, if you're happy to answer it. I just shared something on Twitter early today about the spread of the 10-year and 3-year bond, which has reached the biggest kind of differential, negative 1% roughly. The worst differential in 40 years, which is the ratio is kind of known as the best recession indicator. It even predicted the 2020 crash, which is a weird thing for it to be able COVID. Somehow. But I'm just wondering how you guys think about something to that. Does that affect the type of companies you look towards? Are you expecting a recession? I guess we're kind of already in one, but if you expect it, does it change how you invest, or how do you think about it?
It's definitely a short-term headwind for a stock both me and you own, Frank, which is a small Massachusetts bank. So when you got a really flat or inverted yield curve, that's not that good for borrowing short and lending long. So I don't know, you sort of have to assume that these things normalize over time, but it's probably why that stock's down quite a bit. But recession stuff are too hard. I don't know. You guys can speculate.
How about you, Karan?
Thoughts on no comment, literally. Like, okay, if there is a recession, so be it. Like,
so is it more so you're always looking for recession-proof businesses, or a time like this doesn't make you lean more towards those type of businesses?
we've gone through holding Alibaba, so any recession is like, gone through 2 years of shit with Alibaba.
We got the master class. What's a
Yeah,
recession?
Yeah, imagine owning Tesla instead.
Right.
Just kidding. Yeah, I don't know. I think anytime you buy any stock, you have to kind of run it through the ringer mentally of how it might perform in a whole bunch of different environments. Like it's got to be resilient enough. But I don't know that I'd sort of like rotate like a big mutual fund might towards a certain sector or anything.
I've seen a lot of people talking about how bonds are again interesting because now they think that there's going to be a rate cut, so on and so forth. So you could see a rally in bonds. It's like, okay, great, but like, how much will you make on that? What, like 2-3% on the recovery, and then again you switch it over to something else, and then you keep moving your portfolio around.
Yeah.
Well, it could be a lot more if you're kind of speculating on the price of the bond rather than just capturing the coupon.
That's what, if you're wrong, I mean, unless you structure it using options or something completely different, you tend to lose a lot more than you can possibly make. So, or at least the risk and reward isn't really asymmetric and disproportionate. It's pretty much like you gain one or lose one. So
yeah. To be honest, I think if anything, you find a bunch of opportunities and things where their business is about to get slaughtered, and people are expecting that to happen, and the valuation's gone way down. Which is kind of inverse to what some dude on CNBC is probably talking about. But it's like a bit of a time arbitrage that people, individual investors can look at.
We got a super chat from Luis also.
Luis,
love the new watch, Frank. Show us the watch.
Where's my camera? There. It's an old one, cheap. It's actually not an expensive watch. Looks nicer than it is, but thanks anyway.
Does it actually tell the time, or is it just purely for appearances?
No, it tells the time. Here we are. We're 2:25 Australian time, PM.
It seems 3 minutes out to me.
It's actually 22. That's gonna. It's. I read it.
It's a user error right there.
User error. That's right.
I like the decimal points on that super chat too. Thank you very much, Luis.
Thank you.
Right. Any other questions you guys want to?
I saw this one. If anyone knows at the top of their head which stocks were your worst detractors in 2022, I might pull mine up just to check.
Yeah, I'd have to.
I think I know what it is, but
probably Alibaba, but I'll tell you in a sec.
I had Porsche. Porsche really was rubbish last.
I think mine would have been AFL, Australian Family Lawyers. Alibaba actually wouldn't have. The Chinese stocks kind of worked out.
They really recovered in November.
Yeah. And then I did a bit of averaging down on those as well. So they weren't as bad as they could have been.
I'm almost at 100% return from when Jeremy Raper called me insane for that tweet.
Oh, that's hilarious. You need to share that straight away.
I'm like at 87%, I think, up from the lows. Yeah.
I think that tweet might be close to the absolute bottom. It might be the day of the bottom. Jason
nailed the bottom. He literally bought the bottom in Chinese stocks.
Well, let's not call it the bottom yet. Let's not get ahead of ourselves. Things could turn upside down yet.
Okay. Let's see.
Oh, wow. Yeah. IEX is down a bunch.
I think all Indian stocks across the board are getting crushed. Yeah.
Okay.
I think it's actually a New Zealand ETF that I have, which is pretty small in my portfolio, was the biggest detractor.
Wow.
So there you go.
Mine was by far Australian Family Lawyers. So it was minus 51% for the year. The next worst was Hingham, which was minus 10%. So by far, Australian Family Lawyers was the biggest loser for me.
Has your thesis changed at all on that, Frank? Or are you just holding tight?
Everything kind of about the company changed. The founder CEO left pretty early on. Then the CFO, I think he was at the time, stepped up to the CEO role. He's now gone. There's an activist shareholder in now. Everything's. I'm holding a bag on that one, but everything's changed about it. It's just I haven't. If I come across something, I might shift money away from that one, but I'm happy to leave it there and see what happens. The activist shareholder that stepped in, I'm actually really interested to see what he would do. And he's actually just a popular guy on Twitter as well. Runs an interesting fund in Australia that I follow. That'll be interesting to see how it plays out, but the thesis has totally changed. So
Is Tristan still in it?
I'm not sure.
Not sure.
And I don't know how public he is with his positions anymore. Either,
Not at liberty to say.
All right, of course.
Yeah.
Yeah, I don't know.
I saw that he left KPG, so I thought maybe now he's in the activist game. So
I don't know if he's in the activist game. Yeah, he left his job at KPG, not the shares, as far as I know.
Frank, did foreign exchange have a big impact on your results last year?
Let's see. Not really. Most of mine were about flat or some even positive. I had a UK stock that was down 5% on currency and a US stock that was down 6% on current, or 7% on currency. The rest were all positive. So not really.
Yeah. Yeah, I'm in the same boat. Like I thought Alibaba would have been the biggest detractor, which if you purely just look at the stock price, it's not quite, but it's close. But apparently I've picked up 7% positive just on foreign exchange. So I don't know, that stuff's weird. I think I said this on a podcast a while back, but I would much rather prefer it to be the other way around. Like anytime the US stock market is crashing, the US dollar seems to get very strong. And my New Zealand dollars and your Australian dollars, Frank, have less kind of buying power in the States as stock prices go down. It's like some people like it as like a bit of a natural hedge type thing, but you'd almost prefer just way more volatility and you're getting crushed on foreign exchange and stock price at the same time, and then, doing well on both at the same time. Yeah. All right. Should we take one more question then wrap this up?
Also, if people have topic ideas for next week, they can share them in the comments.
Yeah, we need topic ideas. We always run out of those. So if you
we'll
want to
just
hear
ask
something,
Chat GPT for topic ideas. That's fine.
Exactly. Yeah.
Well, we can use our own chat. We've got a chat right here with 57 people smarter than Chat
Well,
GPT.
we don't know if they're real or not. They might just be bots. I know Luis he looks like a bot to me.
I've met Luis in
Generous
person.
bot.
I
generous
can
bot.
attest to Luis not being a bot. So
No, it's Luis.
yeah.
Luis is glad that none of us are talking about FTX. I think that's Jack's biggest detractor of 2022. Yeah. I think Jack lost a lot of money because he was one of the shareholders of FTX.
He was a shareholder of FTX.
Yes.
Right.
He held FGT. Yeah.
How come he's not on CNBC? All right.
Any other questions?
It's Friday the 13th next week. Well, for us in the US. So we could do a spooky episode.
Spooky. What can we cover that's spooky in the stock market?
Funeral stocks.
Funeral
home stocks.
I've got one of those that didn't play out the way I liked either.
Right.
It actually re-rated by about 30% the other day. It's almost certain that it's going to be bought out, but it kind of gave me a decent return, but ruined the overall thesis. And I guess the fact that someone's willing to buy it might prove the thesis correct. It's just that the minority shareholders don't really get a say, and we won't get to see what happens there.
Yeah.
What are we going to do? Run chat? We've got a chat right here with 57 people smarter than ChatGPT. How come he's not on CNBC?
Yeah.
So unless one of you guys are really rich and want to go activist on a UK funeral stock, let me know.
No, I'll leave that in your capable hands. All right, let's wrap it up, guys. We're locking in funeral stocks for next week, or people can leave comments if we've got a better.
Let's see the comments.
We'll do that.
Hit us up on Twitter too. We're all over there. So
yes. Cool. Thanks everyone for watching. It's been another good week. Good to be back for 2023. Although you guys, I think, already were. I'm really just saying words while I figure out how to play this outro in the background. So.
You're doing well. I wouldn't have guessed
Is this
that.
good? Is this good cover?
Yes.
Okay, great. Oh, is that you, Frank? Are you messing?
Yeah, I pulled up
Are
that.
you also logged in?
Yeah, somehow I can access things. Jack likes to have that on the screen the whole time, but we forgot about it. So
Okay, didn't catch that memo. All right, thanks everyone. We'll see you all next week.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.